Hello and welcome to Session 17 of the Basic Tax Course. We're going to begin Session 17 with a review of the Session 15 quiz answer key. I have up in front of you now the Session 15 quiz, and I'll review with you the most commonly missed questions, beginning with question number 7. Recovery for depreciation claimed on a rental property is taxed at a maximum rate of blank. And of course, we've discussed this so many times in our course so far. Recovery for depreciation claimed on rental property would be recovery of Section 1250 depreciation. And Section 1250 depreciation is recaptured at a maximum rate of 25%. The next most commonly missed question is question number 13. On 1/8/01, Jerry purchased 300 shares of ABC stock for $15 per share. Then on 8/10/04, there was a 2-for-1 split. And then on 10/10/10, Jerry sold 300 shares of ABC stock for $14 a share. What is his net gain or loss? Well, the starting point with this question is to look at the acquisition cost of the shares and the number of shares purchased. We then looked for splits, and there was a 2-for-1 split back in 2004. That 2-for-1 split would double the number of shares Jerry owns and have the cost basis per share. So the number of shares he owns would go from 300 shares up to 600 shares, and the cost per share would drop from $15 a share to $7.50 per share. If he then turns around and sells 300 shares, he would sell 300 shares with a cost of $7.50 per share. So we take 15 over 2, and that gives us $7.50. We multiply that by the 300 shares he sold, and you get $2,250 as a cost basis. Next, we look to the selling price of the shares he sold. He sold at $14 a share, so we take 300 times 14 and get $4,200. Next, we take $4,200 and subtract out the cost basis of $2,250, and we're left with a net gain of $1,950 per share. Since the holding period was more than a year, this is a long-term gain, and that makes the correct answer $1,950 of long-term gain. Question number 14 was the next most frequently missed question. On 1/1/10, Fred inherited 100 shares of ABC stock from his father, who died on 12/1/2009. Fred's father purchased the ABC stock on 1/1/05 for $3,000. The stock at that time had a fair market value on 12/1/09 of $5,500. And then on 1/5/10, Fred sold the stock for $5,000. Well, this is inherited stock. And on inherited stock, we go to the date of death unless the estate sets a date that is 6 months later. But that rarely happens. Most of the time, the fair market value on the date of death is going to be the basis in the stock for the person who has inherited it. So Fred inherited ABC stock, and the fair market value of that ABC stock on 12/1/09 was $5,500. That means Fred's cost basis in his shares is $5,500. If he turns around and sells those shares for $5,000, then he has a $500 loss. And since the holding period of inherited property is always long-term, this will be a $500 long-term loss. Question number 17. Vacant farmland and a commercial office building are considered to be like-kind property. Well, that's a fact, and I did tell you that during the Session 15 lecture, that any form of real estate inside the United States traded for any other kind of real estate inside of the United States is like-kind. And a vacant farmland and commercial office building, although they may not seem the same, they are both real estate, and they are both, therefore, like-kind. Question number 18, which of the following is not Section 1231 property? Well, Section 1231 property is any property held for use in a trade or business for the production of income that is eligible for depreciation or amortization. And it includes Section 1250 property and Section 1245 property, but does not include property that is held for sale. And since inventory is property that is held for sale, it is not Section 1231 property. But rental real estate property, office furniture, and a breeding cow are all property that are held for income production in a business, and of course that would make them Section 1231 property. Number 21, Mr. J purchased a new business use car for $12,000. As down payment, he traded in his old car, which had an adjusted basis of $3,000. The seller of the new car allowed Mr. J a trade-in value of $2,000. How should Mr. J recognize this transaction on his tax return? Well, in this problem, we're looking at the cost of the new car, $12,000, and we're looking at the basis he has in the old car of $3,000. And we look at the trade-in of $2,000. That's why I underlined all of those numbers. So what's happening here? To purchase the new car, he would need to take his cost basis in his old car of $3,000 and add to that any amount of boot he needs to bring. Well, if the cost of the new car is $12,000, but they're only willing to give him $2,000 for the old car, that means he's going to need to bring $10,000 to the table. So you take $10,000 and add that to the $3,000 cost he currently has, and that gives him a like-kind exchange basis in his new car of $13,000. Question number 24. A non-business personal bad debt becomes deductible in the year it becomes worthless as a short-term loss on Schedule D. And that's just a fact you need to know. And here is our mini problem for the day. The mini problem involves John Greystoke, who is single, and during the year he sold the following investments: 400 shares of Tantor Inc. that he purchased on 1/15 of 2006 for $10 a share, and then sold on 3/18 of 2010 for $15 a share. So the starting point for this problem is to look at the shares purchased, the shares sold, and multiply those out by the purchase price and sales price, respectively. Firstly, we have Tantor stock. It's sold for $15 a share, and there are 400 shares. 15 times 400 equals $6,000. It was purchased for $10 a share. 400 times 10 is 4,000. That gives us a gain of $2,000. We look at the holding period, purchased in 2006, sold in 2010, so we know that this will be a long-term sale reportable in Part 2 of Schedule D. Next, we look to the Cala Inc. shares. Cala Inc. was 200 shares, sold for $20 a share. So 200 times 20 is $4,000. 200 times $5 a share purchase price is $1,000 cost. 4,000 minus 1,000 equals $3,000, and that also will be a long-term sale amount reported in Part 2 of Schedule D. Finally, we have the Kerchak Inc. shares. 50 shares for $10 a share is the purchase price, and $8 a share is the sales price. So we in fact have a sale amount of 8 times 50 shares, or $400, but a purchase amount of 10 times 50 shares, or $500. So in the case of Kerchak Inc., we actually have a $100 loss. But we also need to look to the purchase date and the sales date, and we will see that the purchase date and the sales date are less than a year apart. That means that this is a short-term loss that will be reportable in Part 1 of Schedule D. So we go over to Schedule D, and we enter the loss, the short-term loss, in Part 1. And we show the date acquired, the date sold, the sales price, the cost, and the loss. Total sales amounts are $400, and we enter a loss of $100 on line 7. Then in Part 2, we enter Tantor Inc. and Cala Inc., showing the purchase date, sales date, purchase price, and sales price on both of those stocks. We end up with sales amounts of $10,000 because we have sale of $6,000, sale of $4,000, totaling long-term sales amounts of $10,000. The gain on the sale long-term is $5,000. We move over to Part 3, and in Part 3 we total up the loss of $100 in Part 1 with the gain of $5,000 in Part 2, and we end up with net long-term gains on line 16 of $4,900. Now throughout this course, we've had several occasions where I was teaching you about recovery of depreciation and Section 1250 gains, so we had entries on line 19, but there is no entry on line 19 in the case of John Greystoke because he didn't sell any business use assets. He simply sold stock. So when we reach line 16, we're done. And now it's time to do the qualified dividend and capital gain worksheet, which is next. And we begin on this worksheet by entering in the taxable income amount from line 43 of his Form 1040. And in the wording of the problem right here, we tell you the amount on line 43 is $45,750, and that's going to be the starting number that you enter. Now, we've also given you some extra information because we didn't give you tax tables to do this problem, and we've told you that the amount to enter on line 16 of the worksheet is $6,400, and we've entered that right here, line 16. We've also told you that the amount to enter on line 18 of the worksheet is $7,625, and we've entered that here. So let's go see how the worksheet completes itself. We begin on line 1 by entering John Greystoke's taxable income of $45,750. We then subtract out his net long-term capital gain amounts to arrive at a net total on line 7 of $40,850. That is more than the base amount for his filing status, and what this means is that he is in a tax bracket of at least 25% or higher. He is not in a lower bracket. That means he is not eligible for the 0% tax rate, and all $4,900 is essentially going to get taxed at 15%. So when you move down the form, you eventually get to line 14, and that's exactly what you're asked to do. You enter $4,900. Then on line 15, you multiply that by 15%, and you get $735. The next step should have been relatively simple. Take the tax on the remaining $40,850 of income that he has from the tax tables. We already told you that that amount is $6,400, and to $6,400 we add $735, and that gives us $7,135. The tax that the tax tables show on $45,750 of income is $76.25. And John can take the lesser of line 17 or line 18, and of course line 17 is the lower amount. So on line 19 we enter $7,135. So that completes the review of John Greystoke and the review of the Session 15 quiz answer key. Let's move on to the next topic of the day, which is a review of the Session 16 homework assignment. And of course, the homework assignment involved preparation of a tax return for Alana Lang, who has sold her rental home on an installment sale to Lex Luthor. We've given you a list of tax forms to complete. We've also provided you with sales information. The house sold for $180,000, and Lex made a down payment of $40,000. Lana originally bought the rental home in 2001 for $102,000, and at that time the land was worth $22,000. She also had the following closing costs: title charge, other closing costs, and a tax lien paid for the seller. So these amounts right here, $600 plus $800 plus $600, will add to the cost of the property. But when we begin depreciation, we'll have to subtract the land from $102,000 and depreciate the $80,000 difference. Over the years, Lana made the following improvements to the property: a new deck and a new roof. She did not rent out the rental property during the year. It was left vacant to make it easier to sell. And so we are going to begin depreciation on the rental property as follows. We have a cost on the rental house of $82,000, and the depreciable life is, of course, 27.5 years. We figured that the current year depreciation on that property is going to be $118,000. And the other two assets, the deck and the roof, have $238 and $55 of depreciation respectively. These amounts right here are going to total up and be the only expense that Lana had on her rental property for the year. And at the same time they are deductible and as an expense, they are going to reduce her cost basis. So we're going to have to show her net reduction in cost basis on her tax return. Her accumulated depreciation that we've entered here is also, of course, going to reduce her basis. Lex purchased the home under seller-financed mortgage and began making payments on June 1. Lana incurred the following expenses in relation to the sale of her property. They total $16,000, and of course they are going to reduce her gain as well. Let's move over and see what else we have. We have a W-2 for $80,000 and the amortization schedule. We're going to take a look at this amortization schedule, and essentially what we need to do is figure out what amount of interest and principal she has paid for the year. And we can see that we've given you a cumulative of principal payments of $817.46. So we're going to add that to the down payment that Lex made. He made a down payment of $40,000. We're going to add $817. That means he's made $40,817 worth of payments during the year. We've also shown you in this amortization table that the cumulative interest for the year is $5,702, and that will of course be reportable on Lana's tax return as interest income. So let's go over to the answer key now and see what we have. And let's begin at the top. Lana Lang has sold a business use asset under the installment method. She must continue to claim depreciation on the rental home through the date of sale. A Schedule E is attached to the answer key to report the depreciation expense for that item. Lana will calculate the basis in her rental property as follows. We have the purchase price, the title charges, other closing costs, the tax lien that she paid for the seller, the new deck. So we have total cost basis in the property of $113,000. And here is Lana's 6252. We show that we have sold a rental house on an installment sale. We show the date acquired. We show the date sold and the fact that it was sold to a non-related party. We then show the sales price of the property. There was no assumed loan, and so line 7 and line 5 are the same number. We then enter that cost basis that we showed you of $113,000, and the next step is to enter the amount of depreciation allowed or allowable on line 9. So let's see where we got that number from. So on line 9 of Form 4562, we've entered $28,949, and where did that number come from? Well, we had prior depreciation for the house and improvements, which was $27,538. And then we look to the current year depreciation that we are claiming on the house, factoring in, of course, the mid-month convention for the date that the assets were removed from service. And that leaves us with total depreciation being claimed on the property or having been claimed on the property in the amount of $28,949. The next step is to subtract line 9 from line 8 to get the adjusted basis in the property of $84,051. Next, we add in commissions and other expenses of the sale, which totaled $16,000, and that gives us the total amount of cost for the property. We subtract the cost from the sales price of $180,000, and we get $79,949. We then take $79,949 and divide that by the sales proceeds of $180,000, and we're left with a gross profit ratio of 44.416%. Now we need to multiply that amount by the payments received during the year. We received $40,817 in payments for the year. Multiply that by 44.416%, and we get $18,129. And of course, that carries over to line 26. And on line 26, the instructions say, enter this amount here on Schedule D and on Form 4797 and refer to the instructions. Well, the question is, was this the sale of a capital asset or was it the sale of a non-capital asset? It was the sale of a non-capital asset because it was an asset held for income production in a business. Therefore, we're going to go over and make this entry on Form 4797. So let's go do 4797 next. And the starting point on Form 4797, as always, is page 2, where we enter the rental home as a description, the date acquired, the date sold, and then we show the gross sales price, the cost or other basis, depreciation claimed, and the adjusted basis in the property, $100,051. We then look to the total gain, and of course that total gain was carried to the Form 6252. We do enter the total on line 30, however, it doesn't carry to the 1040 as we've done in the past, and the reason for that is that this net gain is being taxed under the installment method, and therefore we go back up to page 1 of the form, and on page 1 of the form, on line 4, we enter the Section 1231 gain from an installment sale reported on Form 6252, line 26 or line 37, and that amount was $18,129. It's really the only income amount we have to enter on the form. So we carry that to line 7, and essentially from line 7, we're going to carry this over to Form 1040 and enter it on line 13. So let's take a look at that. Here we are on the Form 1040, and on line 7 we've entered the amount of W-2 income that Lana Lang had for the year. We've also entered the total amount of interest that Lana received under the installment sale from Lex Luthor, and we got that number from the amortization schedule. The amount is $5,702, and because we have interest income that exceeds $1,500, Lana will need to complete a Schedule B and attach it to her tax return. Then on line 13, we show the amount of gain from her 4797. On line 17, we've entered the loss from the rental property, and I'll show you that in just a minute. And you will see that, as we explained in the instructions for this assignment, that she has no expenses of any kind except depreciation. And why do we have depreciation on there? Can't we just say she had no expenses for the year? Well, oddly enough, the rule for depreciation is that it is required. You have to take depreciation, and so until that property is sold, it was still a rental property, and as long as it was a rental property to Lana, she was required to claim depreciation on it. And so depreciation is the only expense she had for the year. That's $1,411. That $1,411 is a deduction to her because it creates a loss on the property, but it is also an amount that will reduce her cost basis. So we've shown you how that $1,411 was handled on the front of the 1040 and how it reduced her tax basis. Our total income, or Lana's total income for the year, is $102,420. We carry that over to line 38, and then on line 40 we enter her itemized deductions of $9,000. The only itemized deduction she had was $9,000 of state withholding showing on her W-2, but that is more than the standard deduction of $5,700, so clearly she goes with it. We then subtract out her personal exemption amount of $3,650, and we arrive at a number on line 43 of $89,770. Well, the next step is to complete the capital gain worksheet and, of course, fill out the rest of her tax forms. So let's go do that together. First, we have her Schedule A, and on line 5, we've entered the amount of income tax that was withheld on her W-2. Then on Schedule B, we show that Lex Luthor is the person who paid her $5,702 of interest for the year. Then we also have to complete Schedule D. And on Schedule D, we enter the gain from Form 6252 or from 4797, and in Lana's case, they're both the same number, $18,129. We go over to page 2, and on line 16, we enter $18,129. All of her gain is due to recovery of depreciation. So remember that we showed $28,949 of depreciation that has previously been claimed. Her gain is $79,000, but because the recovery of depreciation is Section 1250 gain, we do not need to report more gain in income than Lana received in payments for the year. And ultimately, her payments for the year were $18,129. They are all going to apply first to this depreciation amount on line 9. And when we get into 2011 is going to have some of the payments going towards recovery of Section 1250 gain, and the other part of the payments that Lana receives in 2011 will be taxed as capital gain. But for now, we have the first year on the installment agreement, and in the first year, all payments are going to be applied to that Section 1250 gain. So let's go do the worksheet to show how that works. Here is the Schedule D tax worksheet. We begin by entering Lana's taxable income from line 43 of her Form 1040 form. That was $89,770. Next, we enter the amount of gain shown on line 16 of her Schedule D. That was $18,129. We subtract $18,129 from $89,750, and we enter that total on line 18. We also observe that the amount on line 14 is more than the amount on line 15, which is the base amount for her filing status. Because her income is higher than the base amount for her filing status, we know that Lana is in the 25% or higher tax bracket. Therefore, all of the gain that she is reporting for the year is going to be taxed at a maximum rate of 25%. So ultimately, we continue filling out the worksheet. We eventually get to a point where on line 29, we have $18,129. We multiply that by 25%, and we get $4,532. We then look at the balance or remaining amount of taxable income that Lana has that is going to be taxed at ordinary income tax rates. We go to the tax tables and look up the tax on $71,641. When we do that, we get $14,088. To $14,088, we add $4,532, and we get $18,620. Next, we go look up the amount of tax Lana has to pay on income of $89,770, and we enter that total on line 36. We then get the lesser of line 35 or line 36, and in this case, line 35 is slightly less. And we go with that number of $18,620. This is the amount that we will carry to Lana's Form 1040 and enter on line 44. And on line 44, we enter $18,620. Next, we look to see Lana's withholding. It was $12,000. She's not eligible for any kind of credits, so her withholding is less than her tax, and she owes $6,620. So that concludes the review of Lana Lang's answer key for the Session 16 homework assignment. It's time now to take the Session 16 quiz. So please push pause on video playback. go to the Learning Management System and take the Session 16 quiz. When you are finished taking the Session 16 quiz, resume video playback and we will begin the Session 17 lecture, which covers rental income and expenses. And let's now get going with the Session 17 lecture. And of course, today in the Session 17 lecture, we are moving on to a discussion of rental property. Rental property is actually not that complicated, but there's a lot of rules surrounding rental property that are very specific and can get you in trouble if you don't follow them. So part of today's lecture surrounding rental property is going to be similar to what we saw when we were discussing employee business expenses. You have an expense item. Can you deduct it or not? And if you are allowed to deduct it, what line do you put it on? That part's pretty straightforward. Of course, we also have to factor or calculate depreciation for rental property, and we already covered depreciation in an earlier class. But with rental property, it is now your job to actually figure depreciation and make entries on tax forms. That is the Schedule E. Finally, we're also going to be looking at what happens when you realize a loss on your rental property. Is that loss going to be deductible? And that's one of the more important areas of tax law. That is, when you have a loss on a rental property, am I allowed to deduct it? And if I'm not allowed to deduct it, why aren't I allowed to deduct it? And what happens then? So we're going to discuss all of that today. But we're going to begin by keeping it pretty simple and straightforward. We're going to look at the Schedule E itself. Schedule E is the form where you report income and expenses of your rental property. Before we get going with the actual line-by-line instructions, I wanted to give you an overview of the form itself. Schedule E is actually a two-page form, and page 1 of Schedule E is used to report rental income and expenses. And interestingly, it is also used to report royalty income and expenses. Page 2 of Schedule E serves a different function. But let's take a look at page 1 first. On page 1, you will see that there is space provided to enter up to 3 rental properties. If you have more than 3 rental properties, you would need to attach additional Schedule E pages. Further, Schedule E has columns to enter income and expenses for each property. Down at the bottom of page 1, you total up and determine whether you have a net income or loss from the property. On page 2 of Schedule E, you will see that we have a section devoted to reporting income or loss from partnerships and S corporations. And these are income amounts that flow through to an individual tax filer from ownership shares that they have in an S corporation or a partnership. And in the case of an S corporation or a partnership, those business entities are separate from the individual who files Form 1040. But if an individual owns a share in a partnership or an S corporation, that partnership or S corporation will issue them a K-1. Income from that K-1 flows through to the individual return and is reported in Part 2 on page 2 of Schedule E, page 2. Part 3 is used to show flow-through income reported on a K-1 from estates and trusts. Part 4 is used to report income or loss from real estate mortgage investment conduits or REMICs. And finally, in Part 5, we have a summary where we enter net farm rental income or loss from Form 4835, and reconciliation of farming and fishing income, and reconciliation for real estate professionals. So we're going to be taking a look at most of these lines during today's class. Not all, but most of the lines on this form. The IRS does have a specific publication devoted to rental income and expenses, and you can go read that. But our reading assignment for this course includes only a summary of the most key points of rental income and expenses that you should know about, and those are contained on pages 66 through 77 of Pub 17. We also do recommend that you take a look at publication 925, where rules relating to passive activity and at-risk limits are described. And now let's get on with our lecture. Schedule E, rental income and expenses are reported on Schedule E, page 1. Income from S corporations, partnerships, and trusts reported on Schedule K1 is reported on Schedule E, page 2. Schedule E is used to report income or loss from rental real estate activities, royalties, partnerships, S corporations, trusts, and estates. Do not use Schedule E to report income from rental of personal property, real estate activities if significant services are provided, or royalty income received as a self-employed inventor, writer, artist, etc. Rental income. Rental income is any payment you receive for the use or occupation of property that you own. All of the following forms of payment are considered rental income and must be reported, including money, whether it takes the form of cash, check, credit card payments, etc., or advance rent, or any payment for canceling a lease, or expenses owed by the landlord that were paid by the tenant, or property or services that a tenant gives a landlord in exchange for rent. And here are some examples. Example 1. You agree to forego rent valued at $1,000 for 1 month if your tenant agrees to paint the house he rents from you. You must include $1,000 as rental income for that month. If the paint job was a repair, you can deduct the cost of the paint job as a rental expense. Example number 2. You agree to trade rent for your tenant's car. You must include the fair market value of the car as rental income in the year that you receive it. And example number 3. Your tenant pays the water and sewage bill for your rental property and deducts it from the normal rent payment. Under the terms of the rental agreement, you, and not your tenant, are responsible for paying this bill. You must include the amount paid by your tenant in your income. You can deduct the cost of the utility bill as a rental expense. Security deposits. Security deposits are not rental income if you plan to return the deposit to the party who is renting your property. However, if you later decide to keep the deposit because your tenant does not live up to the terms of your rental agreement, then you must include the deposit in your income for the year the deposit is forfeited. And the first password of the day is the password to open the Session 15 quiz answer key, and the password is Cloud City, CLOUDCITY. Rental expenses. You generally deduct rental expenses in the year you pay them. You can deduct rental expenses you incur to operate and maintain your rental property. You can also deduct any expenses you incur while your rental property is for sale. And let's go on and discuss some of the more common types of rental expenses and where to enter them on the tax form. Beginning with repairs and maintenance. Amounts you spend to keep up your property in good operating condition or to repair damage to the property are allowable as expenses. But remember that improvements are not deductible expenses. An improvement adds to the value of your property or prolongs its useful life or adapts it to new uses. You must capitalize the cost of improvements you make to your property. You can generally depreciate improvements you make to your rental property. Treat each improvement as a separate piece of property for depreciation purposes. Now, returning to this concept, or enhancing a little bit on this concept of improvements to property, generally at the time you place your property in service for rent, you will take the original cost of the property and any improvements you have to the property, lump those all together as a total amount, and then begin depreciation. It's also permissible to pull out each component of the rental property and depreciate those separately. But that's a lot of work. I mean, it's not realistic to say that, okay, I purchased a house and now I'm going to set up a separate depreciation schedule for each component in that house. That would be kind of mind-boggling or ridiculous. So when the IRS says that they want you generally to depreciate improvements you make to your rental property separately, what they mean by that is if you purchase the rental property, there's an acquisition cost to that property, and that would become one line item on your tax return. If at some later point after that property has been in service, you make an improvement such as adding a new roof, now you're going to have another line entry on your depreciation schedule. And then if at a later point you put in a new dishwasher, that would again become a new line entry on the depreciation schedule. But certainly at the time you first place your property in service, you're not going to be required to break out each individual component of that property. That would be really quite ridiculous. So you can generally depreciate improvements you make to your rental property and treat each improvement as a separate piece of property for description purposes. Other deductible expenses. These include advertising, cleaning, and maintenance services, utilities, fire and liability insurance, taxes, interest, commissions for the collection of rent, and ordinary and necessary travel and transportation. Now, points are something that the IRS goes out of its way to describe in detail in its publication on rental property. And since the IRS makes such a point of discussing them, we've always included this discussion in our section on rental property. Points paid when you take out a loan or a mortgage result in original issue discount, or OID. In general, the points or OID are deductible as interest unless they must be capitalized. You may deduct the points you pay on your mortgage if your total OID is de minimis. If your points are de minimis, you do not deduct them in the year paid. You must amortize the points over the life of the loan. And what does de minimis OID mean? Well, the OID is de minimis if it is less than 1/4 of 1% of the stated redemption price at maturity, that is the principal amount of the loan, multiplied by the number of full years from the date of issue or original issue to maturity, that is the term of the loan. And here's an illustration. On January 1, 2010, you took out a loan for $100,000. The loan matures on January 1, 2020, a 10-year term, and the stated principal amount of the loan, $100,000, is payable on that date. An interest payment of $10,000 is payable to the bank on January 2 of each year, beginning on January 2, 2011. Now, obviously, that's not a very realistic or likely scenario, but it gives us simple math numbers to work with, which is why we've worded it this way. When the loan was made, you paid $1,500 in points to the bank. The points reduced the issue price of the loan from $100,000 down to $98,500, resulting in $1,500 of OID. You determine that the points you paid are de minimis based on the following computation. You take the redemption price at maturity, that is the principal amount of $100,000, and multiply by the loan amount in complete years, which is 10. You then multiply that number by the de minimis amount of 1/4 of 1%. When you do that, you get $2,500. The points or OID that you paid of $1,500 are less than the de minimis amount of $2,500. Therefore, you have de minimis OID, and you can choose one of 4 ways in which you can deduct the OID each year, or the points each year. On a constant yield basis over the term of the loan, on a straight line basis over the term of the loan, in proportion to stated interest payments, or in full at maturity of the loan. Under the straight line method, you can deduct $150 each year for 10 years. Not rented for profit. Well, what happens if you don't rent your rental property for a profit? Well, if you do not rent your property to make a profit, you can deduct rental expenses only to the extent of your rental income. You report your not-for-profit rental income on line 21 of Form 1040, and you can claim your expenses up to the amount of your income on line 23 of Schedule A as a miscellaneous deduction subject to the 2% limit. Property change to rental use. If you convert your home or other property to rental use at any time after the beginning of the tax year, you must prorate your expenses between personal and rental use. You deduct your prorated allowable personal expenses such as mortgage interest and property taxes on Schedule A, and you deduct your prorated rental expenses on Schedule E. Here is an example. You converted your home to rental use on April 1, 2010. You claim property taxes and mortgage interest you paid on your home prior to April 1st on Schedule A, and you claim your rental expenses that you paid on your home from April 1st forward on Schedule E. And here's an illustration. Jen converted her home to rental use on April 1, 2010. Her total expenses are as follows. Mortgage interest was $10,500. property taxes were $2,500, and repairs and maintenance after March 31 were $500. Jan must prorate these costs as follows. Mortgage interest is $10,500, and we divide that by 12 because that's the number of months in the year. We then multiply that out by 3 because that's the number of months that Jan lived in the home as her personal residence. So that means that $10,500 divided by 12 multiplied by 3 gives Jan $2,625 of deductible mortgage interest that she will enter on Schedule A. And the remaining amount of mortgage interest, $10,500 divided by 12 times 9, equals $7,875, and that is entered as a deductible expense on Schedule E. We use a similar formula for the property taxes and find that we have, out of the $2,500 of property taxes paid, $625 will carry to Schedule A, and $1,875 are deductible on Schedule E. The repairs and maintenance that were paid after the property was converted to rental use are $500, and those are fully deductible on Schedule E. And of course, no amount of repairs or maintenance paid prior to the point that the property was a rental property are deductible at all, because those are personal non-deductible expenses. Beginning on April 1st, 2010, Jan can also deduct costs she pays for utilities, insurance, transportation, etc. Renting part of property. You must report rental income you receive even if you are only partially renting your property. If you rent out part of your property, you treat the rental and personal portions of your property as two separate properties. And here's an illustration. You own your own home. You decide to get a roommate. You and your roommate share common areas of your home, and other areas are exclusively used by you or exclusively used by your roommate. You must prorate your expenses between personal and rental. Your house is 2,000 square feet with 3 bedrooms and 2 bathrooms. You would divide the use as follows. Exclusive use to you, 500 square feet, and exclusive use to your tenant, 300 square feet, and joint use by both you and your tenant is 1,200 square feet. So you take 500 and add to that half of the joint usage area. So 500 plus 600 equals 1,100 square feet, and that means 1,100 square feet is personal use. We then take 1,100 square feet, divide that by 2,000, which is the total square footage of the house, and we show that 55% of the home is used for personal purposes. We take 300 of tenant use and add that to 50% of the remaining area of the home, which gives us 600. So 300 plus 600 is 900 square feet of use by the tenant. 900 divided by 2,000 of total square footage is 45% tenant use. So you will treat all allowable joint expenses for your rental as 55% personal and 45% rental. So let's put some numbers into this equation now, or some illustrations of expenses into this illustration now. So direct versus indirect expenses. Certain expenses you incur in operating your joint personal rental property will directly relate to renting of your property, and these are called direct expenses. But expenses you pay that are not directly attributable to the rental portion of your property are called indirect expenses. You can claim 100% of your direct expenses on Schedule E. You must prorate your indirect expenses between Schedule E and personal. And here we continue with our illustration. Mike rents out part of his home. His home is 55% personal use and 45% rental use. During the year, he had the following direct and indirect expenses. Repairs to the tenant's room were $200, and the allowed expense will be the full $200. Also, a second phone line for the tenant cost $250, and that full amount is allowed. And then advertising for the tenant to acquire a tenant was $80, and that also is a direct expense, which is allowed. But these indirect expenses, including mortgage interest, utilities, property taxes, maintenance of the home and yard, and depreciation, have to be prorated according to personal and tenant use. And of course, tenant use is 45% of each of these amounts. So $6,000 of mortgage interest at 45% tenant use would give us an allowable deduction on Schedule E of $2,700. Utilities costing $800 would give us allowable deduction on Schedule E of $360. Property taxes would give us an allowable expense on Schedule E of $675. Mortgage interest of $1,000 turns into a $450 expense deduction, and $1,000 of depreciation on the entire property results in a $450 depreciation deduction on Schedule E. Personal use of a vacation home or dwelling unit. You must generally divide the allowable expenses for rental of your vacation home between rental and personal use. However, if you rent your home for fewer than 15 days during the year, you do not need to include the rent you receive in your income, and you do not need to deduct your rental expenses. So this is one of the only places I know of in the tax code where, well, you can make money and not pay tax on it. What this is saying is you could rent out your home for 2 weeks during the year and not have to pay any tax on it. Just take the money in and you're done. And hey, if you live in a city where maybe there's some demand for some lodging for a 2-week special event, say like the Olympic Games or some other big event of that type, you might find you have people looking for a place to stay, and you might be able to bring in a pretty amount of change for renting out your property. As long as it's less than 15 days during the year, you're good to go and you don't have to pay tax on that income. On the other hand, though, if rental use goes over 14 days, now you have to report the income. And the equation then flips the other way. Did you occupy and use your rental property for more than 14 days of personal use during the year, or more than 10% of the days that it was rented? Because if you did, you may not be allowed to claim rental losses. Let's take a look at how all of this works. Completing Schedule E, Part 1 on page 1. And what I've done for you in the course manual here is I've taken Part 1 and I've broken it down into its component parts so that we can look at each part a little more closely, kind of pull it out of the Schedule E form itself and see what we're supposed to do with that specific part. And we begin with line 1. On line 1, you list the type and location of each property that you rented. For example, townhouse, or residential rental, or commercial building. You also enter the street address, city, town, state, and zip. And if your ownership in the property is less than 100%. Then on line 2, we need to answer questions relating to the personal use of the property. You may not be able to claim rental losses on property you used for personal purposes during the year if your personal use of the property was more than 14 days or 10% of the total days that it was rented to others at a fair rental price. So for each rental property listed on line 1, did you or your family use it during the tax year for personal purposes for more than the greater of 14 days or 10% of the days rented? Well, why is this important? Well, it's important because if you check no, you can deduct all of your expenses for the rental part of the property subject to the at-risk rules and the passive activity loss rules, which are explained beginning on page E2 of the Schedule E instructions. And we're going to talk about those a little bit later in today's class as well. But if you checked yes and you rented the unit out for fewer than 15 days, do not report the rental income and do not deduct any rental expenses. If you itemize deductions on Schedule A, you can deduct allowable interest, taxes, and casualty losses. Do not use Schedule E, however, to report income from renting personal property. If you received income from renting personal property, such as cars, boats, tools, report this income as follows. If the rental activity involves the regular rental of property for profit, report income from rent of personal property on Schedule C or CEZ. If the activity is not regular or profit-oriented, report the income on line 21 and report related expenses on Form 1040, line 36. Write PPR for personal property rental and the amount of the expenses on the dotted line next to line 36. Note, though, that if you received income from renting personal property to a corporation in which you are a shareholder, you must report that income on Schedule C. So here we have an example of how we would report income from rental of personal property. On line 21, we would enter personal property rental, and in this case, the amount of income being reported is $4,000. Now, on this particular illustration, line 22 shows $44,000, and clearly that means we have $40,000 of additional income shown somewhere else that is not reflected in this illustration. So we end up with total income of $44,000. We then go down to line 36, and if we had $2,000 of personal property rental expenses, we would enter those expenses on line 36. Line 36 would then be subtracted from line 22, and that would leave us with adjusted gross income of $42,000. Personal use of rental property includes a day of personal use is any day or part of a day that the unit was used by you for personal purposes or any other person for personal purposes if that person owns part of the unit, unless rented to that person under a shared equity financing agreement, or anyone in your family or in the family of someone else who owns part of the unit, unless the unit is rented at a fair rental price to that person as his or her main home, or anyone else who pays less than a fair rental price for the unit, or anyone under an agreement that lets you use some other unit. But personal use of rental property does not include any day you spent working substantially full-time repairing and maintaining the unit, even if family members used it for recreational purposes on that day, or any days you used the unit as your main home before or after renting it or offering it for rent, if you rented or tried to rent it for at least 12 consecutive months, or for a period of less than 12 consecutive months, at the end of which you sold or exchanged it. Personal use exceeds 14 days or 10% of the days rented. If you checked yes and rented the unit out for at least 15 days, you may not be able to deduct all of your rental expenses. You can deduct all of the following expenses for the rental part on Schedule E. So if you check yes and you rented the unit out for at least 15 days, your deductions can be limited, but you are allowed to deduct in full your costs for mortgage interest, real estate taxes, casualty losses, and any rental expenses that are not directly related to the use of the unit as a home, such as advertising expenses and rental agents' fees. If any income is left after deducting these expenses, you can deduct other expenses, including depreciation, up to the amount of remaining income. Carry over to 2011 the amounts that you are not allowed to deduct. And here again is Schedule E, and we've just finished taking a look at line 1 and line 2. Now we're going to move on to the income line, which comes next, and after that, expenses. And line 3, rents received. Report rental income on line 3 if all of the following is true. You received rental income from real estate, and you were not in the real estate business and holding this property for sale to customers, and you did not provide significant services to the renter, such as maid service. Significant services do not include the furnishing of heat and light, cleaning of public areas, trash collection, or similar services. All of the following forms of income should be included on line 3. Income received for renting a room or other space. Fair rental value of services or property you receive instead of money as rent. Also enter the total of all rents in the totals column, even if you have only one property. So you can see that line 3 is where you enter rental income, and if you happen to have royalty income, you would enter the income from each royalty property on line 4. You then total up the total income from all properties on line 3 or line 4 as appropriate. Now, if you are a real estate professional in the real estate sales business, use line 3 only to report rent received from rental real estate held for investment or speculation. Do not use Schedule E to report income and expenses from rentals of real estate held for sale to customers in the ordinary course of your real estate sales business. Instead, use Schedule C or CEZ for these rentals. Rental income from farm production or crop shares. Report farm rental income and expenses on Form 4835. If you received rental income based on crops or livestock produced by the tenant, and you did not manage or operate the farm to any great extent, and you are an individual. Line 4, royalties. Use line 4 to report royalties from oil, gas, or mineral properties, copyrights, and patents. Use a separate column A, B, or C for each royalty property. Enter the total of all of your royalties in the totals column, even if you have only one source of royalties. If you received $10 or more in royalties during 2010, the payer should send you a Form 1099 miscellaneous or similar statement showing the amount of royalty you received. If you are in business as a self-employed writer, inventor, artist, etc., report your royalty income and expenses on Schedule C or CEZ. Next, we're going to be looking at the expense section of Schedule E, and expenses are reported on lines 5 through 21. Enter your rental and royalty expenses for each property in the appropriate column. You can deduct all ordinary and necessary expenses such as taxes, interest, repairs, insurance, management fees, agent commissions, and depreciation, but do not deduct the value of your own labor or amounts paid for capital investments or capital improvements. In the totals column, enter your total expenses for mortgage interest on line 12. I got that highlighted right here. And the total expenses before depreciation or depletion on line 19, and depreciation expenses or depletion on line 20, even if you have only one property. So what this is saying is, if you have only one property, you will enter all of the expense items you have on each line. But when you get to line 12, even though you have only one property, you will also carry that total from line 12 for the single property over to line 12. And if you have multiple properties, you will add up the amount shown in each column for all of your properties and enter that total in line 12. Same goes on line 19. If you have only one property, you make the entry on line 19 and then carry it over to this column. But if you have more than one entry on line 19, total up the entries from all of the columns on line 19 and enter that total on line 19. Renting out part of your home. If you rented out only part of your home or other property, deduct the part of your expenses that applies to the rented part. Credit or deduction for access expenditures. You may be able to claim a tax credit for eligible expenditures paid or incurred in 2010 to provide access to your business for individuals with disabilities. See Form 8826 Disabled Access Credit for details. You can also deduct up to $15,000 of qualified costs paid or incurred in 2010 to remove architectural or transportation barriers to individuals with disabilities and the elderly. You cannot take both a credit and a deduction for the same expenditures. Please refer to Publication 535 Business Expenses for details. Auto and travel. You can deduct ordinary and necessary auto and travel expenses related to your rental activities, including 50% of meal expenses incurred while traveling away from home. You generally can either deduct your actual expenses or take the standard mileage rate. You can use the standard mileage rate for 2010 only if you owned the vehicle and used the standard mileage rate for the first year you placed that vehicle in service, or you lease the vehicle and are using the standard mileage rate for the entire lease period, except the period, if any, that comes before 1998. If you deduct actual auto expenses, include the following amounts on line 6. The rental activity portion of the cost of gasoline, oil, repairs, insurance, tires, etc. Report auto, rental, or lease payments on line 18 and depreciation on line 20. If you take the standard mileage rate, multiply the number of miles you drove your automobile in connection with your rental activities by 50 cents per mile. Include this amount and your parking fees and tolls on line 6. If you claim any auto expenses, actual or the standard mileage, you must also complete Part 5 of Form 4562 and attach it to your tax return. Line 10, legal and professional fees. Include the following expenses on line 10. Fees for tax advice and the preparation of tax forms related to your rental real estate or royalty properties. The following expenses are not reported on line 10. Legal fees paid or incurred to defend or protect title to property, to recover property, or to develop or improve property. These costs must be capitalized and added to the property's basis. Mortgage interest paid to banks, etc. If you have a mortgage on your rental property, enter on line 12 the amount of interest you paid for 2010 to banks or other financial institutions. Do not deduct prepaid interest when you paid it. Points paid to purchase, improve, or refinance the property must be amortized over the life of the loan. Line 13, other interest. If you paid interest to a property that was not a financial institution or you did not receive a Form 1098, report your deductible mortgage interest on line 13. So what happens is that when you make an entry on line 12, that line 12 entry has to have a corresponding 1098 document that was issued by the financial institution. If you do not have a 1098 to show the amount of interest that was paid on the mortgage, then that mortgage expense for interest needs to be entered on line 13. And it's important that you get those numbers right, because if you recall on Schedule A, we have a place to enter mortgage interest that's reported on a 1098, and we have another place to enter mortgage interest that was not reported on a 1098. Well, mortgage interest not reported on a 1098 on Schedule E is reported on line 13. Line 14, repairs. You can deduct the cost of repairs made to keep your property in good working condition. Repairs generally do not add significant value to the property or extend its life. Examples of repairs are fixing a broken lock or painting a room. Improvements that increase the value of the property or extend its life, such as replacing a roof or renovating a kitchen, must be capitalized and depreciated. Utilities. You can deduct the cost of ordinary and necessary telephone calls related to your rental activities or royalty income. For example, calls to the renter. However, the base rate, including taxes and other charges for local telephone service for the first telephone line into your residence, is a personal expense and is not deductible. Line 18. Enter on line 18 any other ordinary and necessary expenses not given a specific line anywhere between lines 5 and 17 or on line 20. You may be able to deduct on this line, that is line 18, part or all of the cost of modifying existing commercial buildings to make them energy efficient. Line 20, depreciation expense or depletion. Begin depreciating your property on the first day it is available for rent. If you purchase a property and do not make it available for rent until you complete improvements or repairs, then the cost of these repairs and improvements is added to the basis of your property. So what they mean by this is, let's just suppose you purchase a rental house and the house needs some fixing up. So you pay $150,000 for the rental house and you keep it off the market for 6 months while you make repairs to it. And let's suppose that you put $50,000 into the house in the form of repairs. But on top of $50,000 of repairs, you also spend $10,000 on mortgage interest, real estate taxes, and utilities. Well, what would happen is you take that $150,000 purchase price, you would add to that the $50,000 of repair costs, and you would add to that again the $10,000 that you paid in property taxes, mortgage interest, and utilities. You add all of that up and you end up with a cost basis of $210,000. What would you do next? Well, you would need to subtract out the land value because land is not depreciable. And let's suppose the land was worth $30,000. Well, you would then take $210,000, subtract out $30,000, and that would leave you with a basis for depreciation in the home of $180,000. Now, of course, when you are claiming depreciation, you have to attach Form 4562. And Form 4562 is required if any of the following is true. Number 1, this is the first year that the property is available for rent, or an improvement was made to the property during the year, or you are claiming depreciation on listed property, regardless of the date it was placed in service. Land and buildings. If you buy buildings and your cost includes the cost of land on which they stand, you must divide the cost between the land and the buildings to figure the basis for depreciation of the buildings. The part of the cost that you allocate to each asset is the ratio of the fair market value of that asset to the fair market value of the whole property at the time you buy it. If you are not certain of the fair market value of the land and the buildings, you can divide the cost between them based on their assessed values for real estate tax purposes. And here's an example. You buy a house and land for $100,000. The purchase contract does not, understandably, because they never do, show how much of the purchase price is for the house and how much is for the land. But you have a real estate tax assessment on the property from the county, and it shows that the assessed value on the date of purchase is $80,000, and that of that $80,000, $68,000 is for the house and $12,000 is for the land. So what you do is you look at that real estate assessment of $80,000 total value and $68,000 for the house only portion. So you've got the structure valued at $68,000 and you have the entire house and land valued at $80,000. So essentially what you want to do is figure out what percentage of the value of the property is allocable to the house. So you take $68,000, divide that by $80,000, and you get 85%. And similarly, you can see that if $12,000 of the assessment is allocated to the land, $12,000 divided by $80,000 would give you 15% of the value of the entire property being for the land. You then take those percentages and multiply them out by the actual acquisition cost of the property. So if you paid $100,000 for a property that the county valued at $80,000, but you can show that 85% of the valuation is attributable to the house, then you would say 85% of $100,000 would give you a depreciable basis in the house of $85,000 and a non-depreciable basis in the land of $15,000. Basis other than cost. There are many times when you cannot use cost as a basis. You cannot use cost as a basis for property that you received in return for services you performed, or in an exchange for other property, or as a gift, or from your spouse or former spouse as the result of a divorce, or as an inheritance. If you received property in one of these ways, you should refer to Publication 551, Basis of Assets, for information on how to figure your basis. Adjusted basis. Before you can figure allowable depreciation, you may have to make certain adjustments, that is, increases and decreases to the basis of your property. The result of these adjustments to the basis is the adjusted basis. Increases to basis. You must generally increase the basis of any property by the cost of all items properly added to a capital account. This includes the cost of any additions or improvements having a useful life of more than 1 year, amounts spent after a casualty to restore the damaged property, the cost of extending utility service lines to the property, and legal fees such as the cost of defending and perfecting title. So additions and improvements. Let's talk about those a little bit. You add to the basis of your property the amount an addition or improvement actually cost you, including any amount you borrowed to make the addition or improvement. This includes all direct costs such as material and labor, but not your own labor. It also includes all expenses related to the addition or improvement. For example, if you had an architect draw up plans for remodeling your property, the architect's fee is a part of the cost of the remodeling. Or if you had your lot surveyed to put up a fence, the cost of the survey is a part of the cost of the fence. Keep separate accounts for depreciable additions or improvements made after you place the property in service in your rental property. The cost of landscaping improvements is usually treated as an addition to the basis of the land, which is not depreciable. Now, the odd thing is, if you recall, that earlier on when we were looking into depreciation or learning about depreciation, we saw that the land improvements have a depreciable life of 15 years. And so how do you differentiate between land improvements that are depreciable and land improvements that are not depreciable? Well, I called an IRS agent who specializes in depreciation and asked him that question. And his answer is, well, you kind of look to the proximity of the improvement to the structure. And, you know, if you've got landscaping surrounding a house, and you really couldn't go in and demolish the house without taking all the landscape in the process, then it's safe to say that the landscaping is really one with the house. But if the landscaping is on acreage and it's separated completely from the house, and you could go in and work on the house and not touch the landscaping, then it's safe to say that that landscaping is not a part of the house and would therefore be a land improvement that's not depreciable. So I would say it's a kind of, it would depend on the facts and circumstances of the situation and obviously on the perspective of the person who's making an opinion in that regard. Assessments for local improvements. Assessments for items which tend to increase the value of property, such as street and sidewalks, must be added to the basis of property. For example, if your city installs curbing on the street in front of your house and assesses you and your neighbors for the cost of curbing, you must add the assessment to the basis of your property. Also add the cost of legal fees paid to obtain a decrease in an assessment levied against property to pay for local improvements. You cannot deduct these items as taxes or depreciate them. Assessments for maintenance or repair or meeting interest charges are deductible as taxes. Do not add them to the basis of your property. Next is deducting versus capitalizing costs. You cannot add to your basis costs that are deductible as current expenses. However, there are certain costs you can choose to either deduct or to capitalize. If you capitalize these costs, include them in your basis. If you deduct them, do not include them in your basis. The costs you may be able to choose to deduct or to capitalize include carrying charges such as interest and taxes, which you must pay to own the property. Decreases to basis. You must decrease the basis of your property by any items that represent a return of your cost. These include amounts of any insurance or other payments you receive as the result of a casualty or theft loss, any deductible casualty loss not covered by insurance, any amount you receive for granting an easement, any residential energy credit you were allowed if you added the cost of the energy items to the basis of your home, and the amount of depreciation you could have deducted on your tax returns under the method of depreciation you selected. If you took less depreciation than you could have under the method you selected, you must decrease the basis by the amount you could have taken under that method. But if you deducted more depreciation than you should have, you must decrease your basis by the amount that you should have deducted, plus the part of the excess that you deducted that actually lowered your tax liability for any year. So what this is saying is rental property is depreciable, and if an asset is depreciable, you are treated as having claimed depreciation when you sell that asset, regardless of whether you actually claimed depreciation as you went. So you might say that depreciation is mandatory. You're going to be treated as if you claimed it, even if you didn't. So you may as well claim it because you're essentially required to. Basis of property changed to rental use. When you changed your property you held for personal use to rental use, for example, you rent your former home, you figure the basis for depreciation using the lower of fair market value or adjusted basis. So what's fair market value? Well, fair market value is the price at which the property would change hands between a buyer and a seller, neither having to buy or sell and both having reasonable knowledge of all the relevant facts. Sales of similar property on or about the same date may be helpful in figuring the fair market value of the property. Figuring basis. The basis for depreciation is the lesser of the fair market value of the property on the date you changed it to rental use, or your adjusted basis on the date of change. That is, your original cost or other basis in the property, plus the cost of permanent additions or improvements since you acquired it, minus deductions for any casualty or theft losses claimed in earlier years' income tax returns and other decreases to basis. And here is an example. Several years ago, you built your home for $140,000 on a lot that cost you $14,000. Before changing the property to rental use last year, you added $28,000 of permanent improvements to the house and claimed a $3,500 deduction for a casualty loss to the house. Because land is not depreciable, you can only include the cost of the house when figuring the basis for depreciation. The adjusted basis of the house at the time of the change in use was $164,500, $140,000 plus $28,000 minus $3,500. And that gives us a basis for depreciation of $164,500. On the date of the change in use, your property had a fair market value of $168,000, of which $21,000 was for the land and $147,000 was for the house. So the cost basis in the house is $164,500, but the fair market value on the date of conversion to rental use for the house is $147,000. This means that the basis for depreciation on the house is going to be the lower of those two numbers. So the basis for depreciation on the house is the fair market value at the date of the change, $147,000, because this number is less than the adjusted basis amount of $164,500. Maker's depreciation under GDS. You can figure your maker's depreciation deduction under GDS in one of two ways. The deduction is substantially the same both ways, and the difference, if any, is slight. You can either compute the deduction using the depreciation method and convention that applies over the recovery period of the property, or you can use the percentage from the optional maker's tables that are shown in publication 946. If you compute the deduction, the depreciation method you use depends on the class of the property. 5, 7, or 15-year property. For property in the 5 or 7-year class, use the 200% declining balance method and a half-year convention. However, in limited cases, you must use the mid-quarter convention if it applies. For property in the 15-year class, you will need to use 150% declining balance method and a half-year convention. You can also choose to use 150% declining balance method for property in the 5 or 7-year class. The choice to use the 150% method for one item in a class of property applies to all property in that class that is placed in service during the year of the election. You make the selection on Form 4562. In Part 3 of Column F, enter 150% declining balance. If you use either the 200% or 150% declining balance method, you figure your deduction using the straight line method in the first tax year that the straight line method gives you an equal or larger deduction. You can also choose to use the straight line method with a half-year or a mid-quarter convention for 5, 7, or 15-year property. The choice to use the straight line method for one item in a class of property applies to all property in that class that is placed in service during the tax year of the election. You elect the straight line method on Form 4562. In Part 3, Column F, enter straight line. Once you make the selection, you cannot change to another method. Special depreciation allowance. You may take a special bonus depreciation deduction of $50,000 for eligible maker's property placed in service during 2010. For qualified property acquired after September 8, 2010 and placed in service before the end of the year, the additional first-year depreciation is 100% of the depreciable basis of the property instead of 50%. You should see Publication 946, How to Depreciate Property, for more information. Section 179 deduction is not allowed for rental property. You may not claim a Section 179 deduction for property placed in service for rental purposes. Depreciation method and convention. You must use the straight line method and a mid-month convention for the residential rental home or commercial building itself. Line 22. Line 22 is where you enter the net income or loss from rental real estate or royalty properties that you had during the year. If the amount shown on line 22 represents amounts for which you are not at risk, use Form 6198 At-Risk Limitations to determine the amount of deductible loss you are allowed to claim. Enter that amount in the appropriate column of Schedule E, line 22, and then in the space to the left of line 22, write Form 6198. Then attach Form 6198 to your return. And we will take a look at that form a little bit later in today's class. So when we get down to the bottom of Schedule E, page 1, on line 22, we show our net total income or loss from the rental property. Then on line 23, we need to enter the deductible loss. And figuring the amount that we are allowed to enter as a negative number on line 23 can be somewhat complicated. And the reason for that is the rules surrounding at-risk limits and passive activity loss limitations. So your ability to claim a loss on line 23 is going to determine whether or not and to what extent you can enter a negative number on Form 1040. So let's go over to Form 1040, and I'm looking here at line 17. Line 17 is where you enter real estate, royalty, partnership, S corporation, trust, income, etc. And line 17 can certainly be a positive number. But there are situations where you may or may not be able to put a negative number on line 17. And when we're talking about losses from rental property, there's some very important rules that we're going to discuss next. So deducting rental losses. Your ability to deduct real estate losses on Form 1040 may be limited by either or both of the following. Firstly, the at-risk limitations, and secondly, the passive activity loss limits. Let's look to the at-risk rules first. At-risk means you have money to lose, or maybe you didn't put money into the activity, but you put property into the activity, and that property had a cost basis to you. So by now you should know what it means to have a cost basis. And to the extent you have a cost basis in property, you are considered to be at risk for that property. Now, generally, you must complete Form 6198 to figure your allowable loss if the following is true. You have a loss from an activity carried on as a trade or business or for the production of income, and there are amounts in the activity for which you are not at risk. You must apply the at-risk rules before you apply the passive activity rules, which are discussed next in this course. So what does it mean to be at risk? Well, amounts considered to be at risk include the amount of money you contributed to the activity, the adjusted basis of property you contributed to the activity, and amounts borrowed by you and contributed to the activity. So what does it mean to be borrowed or to be considered at risk for an amount that you borrowed? Well, to be considered at risk for an amount borrowed, you must be personally liable for repaying the loan or have offered property as collateral for the loan. If you offered property as collateral, you are at risk for the fair market value of your interest in the property. Property offered as collateral for a loan cannot be used in the activity. You are not considered to be at risk in an activity, though, to the extent that you used non-recourse loans to finance the property, but there is an exception for qualified non-recourse financing. You are also not considered to be at risk if the amounts that you contributed or pledged to the activity are protected against loss by stop-loss agreements, guarantees, etc., or for amounts borrowed for use in the activity that come from a person who is not a creditor but holds an interest in the activity. Note that a shareholder's interest in a corporation is not an interest in the activity of the corporation under this rule. Qualified non-recourse financing. Qualified non-recourse financing is financing for which no one is personally liable for repayment and is borrowed by you to hold real property, secured by real property used in the activity, not convertible from debt obligation to ownership interest, and an amount loaned or guaranteed by a federal, state, or local government, or borrowed by you from a qualified person. A qualified person is a person who actively and regularly engages in the business of lending money, such as a bank or savings and loan association. A qualified person cannot be related to you unless the non-recourse financing obtained is commercially reasonable and on the same terms as loans involving unrelated persons, the seller of the property or a person related to the seller, or a person who receives a fee due to your investment in real property, or a person related to that person. Adjustments to at-risk basis. The following adjustment items will affect your at-risk basis. Your basis will increase if you contributed additional cash to the property or the activity, or you assumed additional qualified liabilities, or you received a share of taxable or non-taxable income from a pass-through entity such as a partnership or S corporation. Profits of pass-through entities are passed through to partners and shareholders on Form Schedule K-1. Your share of income from these activities adds to your basis. Your basis decreases if you received a distribution of cash or property from the activity, or you were relieved of a liability relating to the activity, or a recourse debt relating to the activity was converted to a non-recourse debt, or you shared in losses flowing through to you from your ownership interest in a pass-through entity, such as a partnership or S corporation. Recapture rule. Your at-risk basis is less than zero. If your at-risk money in an activity is less than zero, you may be required to recapture previously allowed losses. The recapture amount is the lesser of the negative at-risk amount or the total amount of losses you deducted in earlier years minus any amounts previously recaptured. Activities considered to be covered by the at-risk rules. You are subject to the at-risk rules if you were involved in any of the following activities as a trade or business for the production of income: holding, producing, or distributing motion picture films or videotapes, farming, leasing Section 1245 property, exploring for or exploiting oil and gas, exploring for or exploiting geothermal deposits, any other activity not included in 1 through 5 that is carried on as a trade or business for the production of income. Form 6198, at-risk limitations. Use Form 6198 to figure, in Part 1, your current year profit or loss from an at-risk activity. You use Parts 2 or 3 to figure your at-risk amount for the year, and in Part 4 you figure your allowable deductible loss for the year. And here is Form 6198, and here also is the password to open the Session 16 homework answer key. The password is Tonga, Tonga, and Tonga is a South Pacific island. Who must file Form 6198? Form 6198 is filed by individuals, estates, trusts, and certain closely held C corporations. You must file Form 6198 if you or a partner or S corporation in which you have an interest incurred a loss for the tax year and you had any amounts in the activity which were not at risk. So let's take a look at this form. We will have you work on this form in a very simple form of the form during today's classwork assignment. So Part 1 of the form is used to report the current year profit or loss from an activity and to report losses or deductions from earlier years that you could not deduct because the at-risk rules limited or did not allow you to claim the loss. Use Part 2 if you know your adjusted basis in a partnership or S corporation activity. Part 3 is a longer method of figuring your amount at risk. It may allow you a larger amount at risk than Part 2. If you complete Part 3, do not also complete Part 2. Finally, Part 4. Use Part 4 to figure your deductible loss for the year. If the loss on line 5 is equal to or less than the amount on line 20, report the items in Part 1 in full on your tax return, subject to any other limitations such as passive activity and capital loss limitations. Detailed illustration of at-risk limitation. Here is an example of how it all works. Matt Dillon owns 50% of the S corporation Gunsmoke Inc. Matt's basis in Gunsmoke at the beginning of the year was $20,000. During the year, he contributed another $15,000 to the corporation. Matt is also a guarantor for a $100,000 loan Gunsmoke currently has with First County Bank. Matt's K-1 from Gunsmoke Inc. is shown below. Prepare his Form 6198. So what we'll see here is that the K-1 is showing a $50,000 loss. But Matt Dillon only has a $20,000 basis in his S corporation at the start of the year. During the year, he contributed $15,000, so just mentally we go, okay, well 20 plus 15 means he has an at-risk basis amount in the S corporation of $35,000. But there's also a statement here that says that Matt guaranteed a loan that Gunsmoke currently has with First County Bank. Unfortunately, though, there is a rule that says that if a shareholder in an S corporation guarantees a loan that that S corporation has with a lender, that guaranteed loan amount is not an amount for which that shareholder is considered to be at risk under the at-risk rules. Now, oddly enough, this limitation does not apply to partnerships, but only to S corporations. So the $100,000 loan, which Matt Dillon guaranteed, has no effect on his at-risk amount for this exercise. So Matt's allowable losses from Gunsmoke Inc. cannot exceed his basis. Even though he is guarantor of the loan Gunsmoke has with First County Bank, IRS rules state that Matt is not at risk for the loan directly and cannot increase his basis in Gunsmoke Inc. by the amount he is guaranteeing. Matt cannot claim a larger loss on his Form 1040 return than he is at risk for. His loss on Form 6198 is limited to the amount of capital he has invested. So here we have line 1, and on line 1 we enter the amount of loss shown on the K-1, negative $50,000. There are no other additions or subtractions to that amount, and we carry it down and enter it on line 5. Next, on line 6, we enter his at-risk amount at the beginning of the year, which was $20,000. And to that, we add additional contributions that he made during the year of $15,000. That gives us a total amount at risk for the year of $35,000. We carry $35,000 down and enter that on line 20, and finally again on line 21. So you can read through the form lines and forms and instructions on your own time, but I wanted to show you essentially a completed form here of what it should look like in a very simple situation. And this is a basic tax course, so this is where I'm going to leave it. Now, how does that K1 and Form 6198 entry carry over to Schedule E? Well, for the first part of this class, we've been talking about Schedule E page 1 and how we make entries on Schedule E page 1. But now we're going over and doing an illustration here that involves Schedule E page 2, because we have a K1 flowing through from our ownership share in an S corporation. So that does not carry to Schedule E page 1. It in fact carries to Schedule E page 2. So we begin on Schedule E page 2 by entering the name of the entity that issued the K1, and that entity is Gunsmoke Inc. Then in column B of line 28, we enter S for S Corporation, and in column D, we enter the employer ID number shown on the K1. Next, there's a box that says, check if any amount is not at risk, and in this case, we have some not at risk amount. The amount of loss that Matt is not at risk for is $15,000 out of the $50,000, but he is allowed to claim $35,000 of loss. We enter that $35,000 of loss in column H because the loss is a non-passive loss. He is an active participant in the S corporation. That means he is not passive. And oddly enough, they do not have an active loss column. They just have a not passive column. So that loss then carries over to line 31. You follow through the remaining lines on Schedule E page 2, and finally at the bottom of the form on line 41 we have the net allowable loss for the year. That loss carries to Form 1040 and is entered on line 17. And of course Matt will have an unallowed carry forward loss of $15,000 that will carry forward to 2011. The next topic we're going to talk about is passive activity loss limits. Rental real estate activities are generally considered to be passive activities, and the amount of loss you can deduct is limited. Generally, you can only deduct passive activity losses to the extent that you have income from other passive activities. And here is a historical perspective to help you understand how this came about. Prior to 1986, a taxpayer could generally deduct losses in full from rental activities and trades or businesses, regardless of his or her participation. This gave rise to significant numbers of tax shelters, many of them abusive, which allowed taxpayers to deduct non-economic losses against wages and investment income, thereby reducing or eliminating any tax. The Tax Reform Act of 1986 added IRC Section 469. IRC Section 469 limits a taxpayer's ability to deduct losses from businesses in which he or she does not materially participate and rental activities. Now, beginning in 1994, a relief provision relating to rental real estate was enacted for taxpayers who are real estate professionals and spend most of their time in real property trades or businesses. The new provision allows certain taxpayers to deduct current losses from rental real estate activities in full without any passive loss limitation. As a general rule, the passive activity loss rules are applied at the individual level. Although the Internal Revenue Code Section 469 was enacted to discourage abusive tax shelters, its impact extends far beyond shelters to virtually every business or rental activity, whether reported on Schedule C, F, or E, as well as to flow-through income and losses from partnerships, S corporations, and trusts. Generally, the law does not apply to regular C corporations, though it does have limited application to closely held corporations. So this paragraph right here references an Internal Revenue Code section, and you can read more about this information if you're really curious by clicking or visiting this particular link right here. Categories of income and loss. The Internal Revenue Code divides all income into two categories: passive and non-passive. Passive income reflects rentals and businesses in which a person has ownership but does not materially participate. Non-passive income comes from businesses in which the taxpayer materially participates. So what is passive income? Well, passive income is income generated by a passive activity in the ordinary course of business. There are two kinds of passive activities: rentals, including both equipment and rental real estate regardless of the level of participation, and businesses in which the taxpayer does not materially participate on a regular, continuous, and substantial basis. So what is a non-passive activity? Income and losses from the following activities are generally considered to be non-passive: salaries, wages, and 1099 miscellaneous commission income, guaranteed payments, royalties derived in the ordinary course of business, sole proprietorship or farm in which the taxpayer materially participates, partnerships, S corporations, and limited liability companies in which the taxpayer materially participates, trusts in which the fiduciary materially participates, pension or annuity income, and lottery or gambling winnings. Portfolio income is also non-passive income. Portfolio or investment income is income typically reported on Schedules B or D, and portfolio income includes income from interest, dividends, capital gains and losses, including gains or losses from stocks and bonds, and the sale of undeveloped land or other investment property. So how do the passive activity limitations work? Generally, losses generated by passive activities can only be used to offset income generated by other passive activities, except those upon disposition of a taxpayer's entire interest in a passive activity. Losses from passive activities cannot offset non-passive income from wages or salaries, portfolio or investment income, profits or income from sole proprietorships, farms, partnerships, or S corporations in which the taxpayer materially participates. In other words, a taxpayer cannot deduct losses from passive business activities and rentals unless he or she reports other passive income on the tax return against which the losses can be offset. So these rules really are an effort by the government to prevent an individual from making investments in activities that they know are going to generate losses, and then use those losses to offset other forms of taxable income that they might have for the year. So the passive activity rules say if you are an investor who can really afford to lose money on a money-losing venture, then lose it at your own expense and not the government's. But if somehow you do invest in a venture in which you have no interest other than money, that means you're not working it yourself, and you really do have an expectation that that venture will make money, but in the end it doesn't, well, your losses are going to be disallowed until such time as you can show that you've actually disposed of the entire activity, or you can show you have other passive activities in which you are also invested, and those activities produced income. So let's look at some illustrations of how all of this works. Luke is a 40% owner of Yemen Inc., an S corporation. The daily business activities of the corporation are carried out by employees of the corporation and by other shareholders. Luke's participation is limited to the money he has invested into the corporation. During the year, Yemen Inc. incurred a $25,000 operating loss. Luke's distributive share of the loss is $10,000. Luke will not be able to claim this loss on his personal return unless he has net passive income from another passive business or rental activity. If Luke has no other passive activity income, he must carry his loss on Yemen Inc. forward each year until he either has passive activity income or disposes of his entire interest in Yemen Inc. Passive activity credits. You can subtract passive activity credits only from the tax on net passive income. Passive activity credits include the general business credit. Credits that are more than the tax on income from passive activities are carried forward. So by this time in the course, you know what a credit is, and a credit is used to offset tax. Well, what the IRS is saying in these passive activity credits is that if any of the credits you've generated are being claimed against activities which are passive in nature, then those passive activities have to have generated taxable income. So that if your income is showing tax, and that tax is attributable to profits from a passive activity, then you're allowed to claim a credit from a passive activity to offset that passive tax or passive income tax. Now, there is an exception to these passive activity loss rules, and it relates to active participation in a rental real estate activity. You may be able to deduct up to $25,000 of loss on your rental real estate if you actively participate in managing your rental real estate. Active participation is a lower standard of involvement than material participation. If you meet the active participation test, you can deduct up to $25,000, $12,500 if you are married filing separate and did not live with your spouse during the year. Of rental real estate losses, if your modified adjusted gross income is $100,000 or less, half that amount if you are married filing separate and did not live with your spouse at any time during the year. The amount of your allowable passive activity loss for your rental real estate is reduced and gradually eliminated when your modified adjusted gross income is between $100,000 and $150,000. The $25,000 special allowance is phased out at a rate of 50 cents for each dollar your modified adjusted gross income exceeds $100,000. And the deduction begins to phase out at $50,000 if you are married filing separate and did not live with your spouse during the year. But if your filing status is married filing separate and you did live with your spouse, then your allowable loss is zero. So let's look at modified adjusted gross income and the definition of that. You will have learned throughout our course that modified adjusted gross income has multiple definitions depending on what income, credit, or deduction item that we are talking about. And for purposes of passive activity losses from rental real estate activities, your modified AGI is the AGI shown on line 38 of Form 1040, figured without taking into account any passive income or loss or any loss allowed by reason of the exception for real estate professionals, and any taxable Social Security or equivalent Tier 1 railroad benefits, or deductible contributions to an IRA or certain other qualified retirement plans, or the deduction for 1/2 of self-employment tax, or the deduction allowed for student loan interest or tuition and fees, the exclusion allowed for employer-provided adoption benefits, the exclusion allowed for qualified U.S. savings bond interest used to pay higher educational expenses, the deduction for domestic production activities, or any overall loss from a publicly traded partnership. Active participation. As an active participant, both of the following rules apply. You and your spouse owned at least 10% of the rental property, and you made management decisions in a significant and bona fide sense. Management decisions include approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. Exception for real estate professionals. For any portion of the year that you were a real estate professional, your losses from active management of your rental real estate are not passive activity losses. A real estate professional who owns and manages rental property is deemed to have non-passive income from the rental property. As such, the real estate professional meets the material participation rule, and his or her losses on rental activities are not limited by the rules relating to passive activity losses. So who then qualifies as a real estate professional? You qualify as a real estate professional if both of the following requirements are met. Number 1, more than half of the personal services performed during the year in all trades or businesses for the year were performed in real property trades or businesses in which you materially participated, and you performed more than 750 hours of services in the year in real property trades or businesses in which you materially participated. Note that personal services performed as an employee do not count unless you owned more than 5% of the employing company. So what is a real property trade or business? Your business is a real property trade or business if it does any of the following with real property: develops or redevelops it, constructs or reconstructs it, acquires it, converts it, rents it or leases it, operates or manages it, or brokers it. Real estate professional election to treat all interest as one activity. If you are a real estate professional, you can choose to treat multiple real estate interests as only one activity. You can make this choice for any year you qualify as a real estate professional. Once you make the choice, the following rules apply. The choice is binding for the tax year you make it and for any later year that you are a real estate professional. The choice will continue to apply to years where you are not a real estate professional. However, for any year you are not a real estate professional, the rental activity will be subject to the passive activity limits. Grouping is important because if the activities are separate, you must show material participation in each one. If the activities are grouped, you only need to show participation in all of the activities as a whole. So how do you make the election to treat all activities as one activity? Well, you attach a statement to your return that says, I elect Section 469C7A. This election must be properly made in order for it to be accepted by the IRS. And here is an illustration of how we would prepare a return for a real estate professional. You can see we have a very large rent amount here, and we can just assume that this real estate professional has elected to treat all properties as a single property. And we have, therefore, $100,000 of income and all of the expenses that this real estate professional is claiming. Real estate professionals, when they get to the bottom, can show a loss on line 22. And then because they're real estate professionals, they can carry the loss in full to line 23, even if it exceeds $25,000. So let's take a look what comes next. You can see here that I've circled deductible rental real estate loss. Caution, your real estate loss on line 22 may be limited. See page C5 to find out if you must file Form 8582. Real estate professionals must complete line 43 on page 2. Well, we're doing a Schedule E for a real estate professional, so let's go do that. Also on line 26 it says total rental real estate and royalty income or loss. Well, the amount of loss that you enter on line 26 will carry over to line 41, where we enter total income or loss. And then a decision is made on line 43, which is where we enter reconciliation for real estate professionals. If you were a real estate professional, enter your net income or loss you reported anywhere on Form 1040 or 1040-NR for all real estate activities in which you materially participated under the passive activity loss rules. So line 43, the loss is allowed, and that would carry to line 17 of Form 1040. So what then is material participation? The Internal Revenue Code defines material participation as regular, continuous, and substantial participation by a taxpayer. Determining whether an activity is passive or non-passive is done on an activity-by-activity basis and at the 1040 level. A taxpayer is generally deemed to be materially participating in an activity if he or she works more than 500 hours a year at the activity or performs substantially all of the work in a business. If you materially participate in an activity, the activity is not passive and losses are not limited. Conversely, however, if a taxpayer works 500 hours or less during the year or does not perform most of the work, losses are not allowable unless he or she has passive income. Generally, a passive activity is any rental activity or any business in which the taxpayer does not materially participate. Non-passive activities are businesses in which the taxpayer works on a regular, continuous, and substantial basis. In addition, passive income does not include salaries, portfolio, or investment income. A trade or business activity is not a passive activity if you materially participated in the activity. And here are the material participation tests. You materially participated in a trade or business activity for a tax year if you satisfy any of the following tests. Number 1, more than 500 hours of participation. You participated in the activity for more than 500 hours. If you did, it is not a passive activity. Or your participation was substantially all of the participation. You provided virtually all of the participation in the activity, and under this test, little or none of the participation can come from other owners of the activity or from employees of the activity. Or more than 100 hours and your participation was the majority of participation. That is, you participated in the activity more than 100 hours during the year and you participated at least as much as any other individual, including individuals who did not own any interest in the activity for the year. Significant participation activity. If you have more than one activity, you meet this test if you participated in all activities for more than 500 hours during the year and you participated in each activity more than 100 hours during the year. A significant participation activity is any trade or business activity in which you participated for more than 100 hours during the year and in which you did not materially participate under any of the material participation tests other than this test. The activity is also not a passive activity if you had material participation in the activity for any 5 of the 10 immediately preceding tax years. If you materially participated in the activity for any 5 taxable years during any of the 10 years immediately preceding, but the earlier years do not have to be consecutive. Also, if the activity is a personal service activity for any 3 preceding tax years. If you materially participated in any 3, whether or not they were consecutive, preceding tax years in a personal service activity. An activity is a personal service activity if it involves the performance of personal services in the fields of health, including veterinary services, law, engineering, architecture, accounting, actuarial service, performing arts, consulting, or any other trade or business in which capital is not a material income-producing factor. Or you participated in the activity on a regular, continuous, and substantial basis during the year. You did not materially participate in the activity under this test if you participated in the activity for 100 hours or less during the year. Your participation in managing the activity does not count in determining whether you materially participated under this test if any person other than you received compensation for managing the activity or any individual spent more hours during the year managing the activity than you did, regardless of whether the individual was compensated for the management services. Participation defined. In general, any work you do in connection with an activity in which you own an interest is treated as participation in the activity. But wait, work not usually performed by owners. You do not treat work you do in connection with an activity as participation in the activity if both of the following are true. The work is not work that is customarily done by the owner of that type of activity, or one of your main reasons for doing the work is to avoid disallowance of any loss or credit from the activity under the passive activity rules. Participation as an investor. You do not treat the work you did in your capacity as an investor in an activity as participation unless you are directly involved in the day-to-day management or operations of the activity. Work you do as an investor includes studying and reviewing financial statements or reports on operations of the activity, preparing or compiling summaries or analyses of the finances or operations of the activity for your own use, and monitoring the finances or operations of the activity in a non-managerial capacity. Spouse's participation. Your participation in an activity includes your spouse's participation. This applies even if your spouse did not own any interest in the activity and you and your spouse did not file a joint return for the year. Sale of a passive activity. You may generally deduct any prior year's suspended losses and current year passive activity losses if you dispose of your interest in the activity during the year. This rule applies if you dispose of your entire interest in the activity and you did not make the sale to a related party. And here is an illustration. Donald Duck disposed of his entire interest in Daisy LLC in a sale to an unrelated party. Donald is a passive partner in the business and has $13,000 of prior year suspended losses. His current year passive income is $5,000. Donald has no other passive activity, income, or loss for the year. Complete his Schedule E, page 2, as shown next. So here we have Donald Duck's Schedule E. He has a prior year unallowed suspended loss of $13,000, and from that he will subtract $5,000 of current year income. That leaves him with a net loss of $8,000. And because he has disposed of his entire interest in Daisy LLC for the year, he will be allowed to claim that $8,000 loss because this is the year of disposition. So the $8,000 loss is shown in the passive column. It carries over to line 31 and line 32 respectively. We carry that number again down to line 41. And on line 41 it says total amount of loss. Enter the result here and on Form 1040, line 17. So, of course, this loss will carry over to Form 1040 and is entered on line 17. Dispositions other than by sale. If you dispose of your property other than by sale, additional rules apply as follows. Inheritance. Suspended losses are reduced by stepped-up basis. Excess losses are claimed in full on the final return of the decedent. Like-kind exchange. Your suspended losses remain suspended losses on the new property that you acquired. However, suspended losses are deductible to the extent of any taxable boot you receive from the exchange. Installment sale. Suspended losses are deductible each year a gain is realized. Sale to a related party. Your suspended losses remain suspended loss until such time as the related party sells the property to an unrelated party or you have other passive income. If you transfer property in a divorce, your suspended passive losses associated with the activity are transferred to your spouse. Your spouse who receives the property will add the suspended losses to his or her basis. Passive activity changes to non-passive activity. If you became active in an activity where you were previously passive, your prior year suspended losses remain passive losses. Suspended losses may be claimed to the extent of income produced from the activity plus income from all other passive activities. Unallowed passive activity credits. Prior year unallowed passive activity credits cannot be claimed when you dispose of your entire interest in a passive activity. However, the amount of unallowed credit can be used to determine your gain or loss upon disposition of the activity. You can elect to increase your basis in a passive activity by the amount of original basis reduction attributable to the unallowed credit, to the extent that the credit was not allowed because of the passive activity limits. You cannot elect to adjust the basis for a partial disposition of your interest in a passive activity. See the instructions for Form 8582CR for more information. And here is an example. Richard Boone disposed of his entire interest in the passive activity Paladin LLC. He has a prior year unallowed disabled access credit in the amount of $2,000. Richard can elect to increase his basis in Paladin LLC by $2,000. Activities that are not passive activities. The following are not passive activities. A trade or business activity in which you materially participated for the tax year. A working interest in an oil or gas well which you hold directly through an entity that does not limit your liability, such as a general partner interest in a partnership. It does not matter whether you materially participated in the activity for the year. The rental of a dwelling unit that you also used for personal purposes during the year for more than the greater of 14 days or 10% of the number of days during the year that the home was rented at fair value. An activity of trading personal property for the account of those who own interests in the activity, or rental real estate activities in which you materially participated as a real estate professional. Rental income reported as self-employment. If you provided significant services that are primarily for your tenant's convenience, such as regular cleaning, changing linen, or maid service, you do not report your rental income on Schedule E. Instead, report your rental income and expenses on Schedule C as profit or loss from a business. Rental income from real estate and personal property leased with real estate is not included in earnings subject to SE tax unless either of the following applies to you. You are a real estate professional or you provide services to your tenants. Real estate professional. You are a real estate professional if you are engaged in the business of selling real estate to customers with the purpose of making a profit from those sales. Rent you receive from real estate held for sale to customers is subject to self-employment tax. However, rent you receive from real estate held for speculation or investment is not subject to self-employment tax. Trailer park owner. Rental income from a trailer park is subject to self-employment tax if you are a self-employed trailer park owner who provides trailer lots and facilities and substantial services for the convenience of your tenants. You generally are considered to provide substantial services for tenants if they are primarily for the tenant's convenience and normally are not provided to maintain the lots in a condition for occupancy. Services are substantial if the compensation for the services makes up a material part of the tenant's rental payments. Examples of services that are not normally provided for the tenant's convenience include supervising and maintaining a recreational hall provided by the park, distributing a monthly newsletter to tenants, operating a laundry facility, helping tenants buy or sell their trailers, Examples of services that are normally provided to maintain the lots in a condition for tenant occupancy include city sewage, electrical connections, and roadways, hotels, boarding houses, and apartments. Rental income you receive for use or occupancy of hotels, boarding houses, or apartments is subject to self-employment tax if you provide services for the tenants. Generally, you are considered to provide services for the occupants if the services are primarily for their convenience and are not services normally provided with the rental of rooms for occupancy only. An example of a service that is not normally provided for the convenience of occupants is maid service. Examples of services that are normally provided to tenants include providing heat and light, cleaning stairways and lobbies, and collecting trash. And we are just about done with the lecture portion of today's class. I'm going to give you the password to unlock the Session 17 classwork answer key. You haven't done the assignment yet, but I'm trusting you to reserve this for when you need it. The password is BARB, B-A-R-B. And the final topic of today's lecture is Form 4835, Farm Rental Income. The IRS did indicate at one point this is a topic that they might question on or include a question about in the IRS Tax Preparer Test. Form 4835 is used if you were the landowner or sublessor and did not materially participate in the operation of the farm. You report farm rental income that you received based on produce, grains, or other crops or livestock produced by the tenant. Under both the cash and accrual methods of reporting, you must report livestock or crop share rentals received in the year you convert them into money or its equivalent. Do not use Form 4835 if you were a landowner and you materially participated in the operation or management of the farm. Report this income on Schedule F. Do not use Form 4835 if you were a landowner and received cash rent for pasture or farmland based on a flat charge. Use Schedule E to report this type of income. So Form 4835 is a very specialized form. It is used to report income that you receive from the share of crop or livestock sales that a tenant farmer has basically contractually obligated to share with you as a condition of using your land. If you're simply renting the land to the farmer, then that farmer is going to pay you rent, and that goes on Schedule E. And here is the classwork assignment for the day. It involves preparation, of course, of a Schedule E. And while we're at it, we're, of course, going to throw in a Schedule E page 2, as well as the Depreciation Form 4562, the At-Risk Limit Form 6198, and the Passive Activity Loss Limit Form of 8582. And here is the problem. In January of 2010, Rudolph Deere bought a condominium apartment to live in. Instead of selling the house he had been living in, he decided to convert it to rental property. Rudolph selected a tenant and started renting the house on February 1st. Rudolph charges $1,200 a month for rent and collects it himself. He also received a $1,200 security deposit from his tenant, which he plans to return at the end of the lease. Rudolph had the following expenses for the house during the year: mortgage interest of $8,500, fire insurance under a 1-year policy of $200, miscellaneous repairs that he paid after he began renting the property of $350, real estate taxes of $2,000, and auto expenses at the standard mileage rate. And he drove 250 rental miles and 12,500 other miles. Rudolph bought his house back in 2001 for $100,000. $33,000 was allocated to land value and $67,000 towards the value of the house. Before changing the home to rental property, he made the following improvements: remodel of the kitchen, $5,000, a recreation room, $5,000, a new roof, $1,500, a patio and a deck, $3,400. Then on February 1, when Rudolph changed his home to rental use, the property had a fair market value of $150,000, $50,000 of which was for the land and $100,000 for the house. Because Rudolph's adjusted basis is less than the fair market value of the land on the change, Rudolph must use his adjusted basis for figuring depreciation. On April 1, 2010, Rudolph bought a new dishwasher for the rental property at a cost of $450. The dishwasher is personal use property used in a real estate activity and has a 5-year recovery period. He will use the half-year convention to figure his depreciation deduction for the dishwasher. Then on June 1, 2010, Rudolph installed a new central air conditioner and furnace in the house. The cost of the units and the installation was $4,500. The air conditioning and the furnace are residential rental property and must be depreciated over 27.5 years. Rudolph will use the illustrated depreciation schedule. So we've taken some kindness on you. We are providing you with the depreciation schedule rather than making you figure this all manually. But if you really are dedicated to learning more about depreciation, you could, of course, sit down and see if you can manually come up with these same numbers. Rudolph received a W-2 and 2 Schedule K-1s as shown next. Rudolph is a passive partner in Reindeer LLC. His capital account is accurately reflected on his 1065 Schedule K-1. And of course, his capital account shows his at-risk amount in the activity. Rudolph is also an active partner in Toy Makers Inc. Rudolph's capital account at the beginning of 2010. Rudolph is also an active partner in Toy Makers Inc. Rudolph's capital account at the beginning of 2010, Toy Makers Inc. was $0, and during the year he contributed $2,000 to the business. Rudolph will receive a $400 Making Work Pay credit, prepare his federal return. And here is his W-2 showing $50,000 of federal income, $5,000 of federal tax was withheld, and of course he lives at the North Pole in Alaska. Here is the K-1 for the 1065. You can see that he has a $10,000 loss. His capital account shows he began the year with an opening account basis of $20,000. He's got a current year decrease of $10,000 and a year-end capital account of $10,000. And here is his K-1 for the S Corporation. It shows an ordinary loss for the year of $50,000. So at this point, please push pause on video playback and complete the tax return for Rudolph Deer. When you are finished preparing Rudolph's tax return, please resume video playback and I will do a review of the answer key with you. So I have up in front of you now the answer key for the Session 17 classwork assignment involving Rudolph Deer. And let's just start at the beginning with Form 1040, and the simplest line to enter on that form, line 7, where we enter the $50,000 of wage income from his W-2. But now we've got a number on line 17 that is negative $2,000, and getting that number is a multi-step process. And let's begin the process by looking at his Schedule E. And here we have Rudolph's Schedule E. You will see that in Part 1, we begin by entering that the property has a description of residential rental and the location is the North Pole. There is a question that asks, did you use the property for personal purposes during the year for more than 14 days or 10% of the days rented? And the answer is no. We then begin on line 3 by entering the rents received. And Rudolph received $1,200 a month for rent beginning on February 1. So that would be 11 months of rent. 1,200 times 11 is $13,200. Next, we have all of the other expenses that he incurred for the year that were ordinary and necessary expenses of operating that rental property, including line 6, auto and travel. And in the wording of the problem, we told you that Rudolph drove 250 miles for the rental property, and the standard mileage rate for 2010 is 50 cents a mile. So 50 cents times 250 miles gives us a $150 deduction to enter on line 6. Then on line 9, we enter insurance. But if you follow over here and look at the wording of the problem, we're telling you that he paid for a 1-year policy, but the property was only rented for 11 out of 12 months. So essentially, we're going to take 200, divide that by 12, and multiply it by 11 for the number of months rented, and we end up with a $183 deduction on line 9. Next, we have mortgage interest, and again, the same ratio applies. For the mortgage interest, we're going to look at the total amount of mortgage interest paid, which was $8,500. We'll divide that by 12, multiply it by 11, and we get $7,792. We also had miscellaneous repairs that were paid after the property was rented, totaling $350, and those are not prorated because they are exclusive to tenant use, and so we enter $350 on line 14. And finally, the real estate expenses paid were $2,000. We take $2,000, divide that by 12, multiply it by 11, and we get $1,833. You'll note that on line 12, we carry the total of the mortgage interest shown on line 12 over to the final column. Then on line 19, we total up our expenses for the year. And the total expenses shown on lines 6 through 16 total $10,283. We then enter the depreciation deduction for the year, and let's see where that number came from. And here is Rudolph's depreciation schedule. You can see that current depreciation on the schedule totals $2,785. We carry that over and enter it on line 20. Finally, total expenses for the year are $13,068, and both the amounts on line 19 and line 20 carry over to the far right column. Next, we see that the total income for the year was $13,200, and total expenses for the year were $13,068, leaving Rudolph with a net profit of $132. He carries $132 down to line 24, and again enters it on line 26. Now it's time to take a look at some of the other activities that Rudolph has going on. And let's take a look at both of those K1s that he had, beginning with the K1 for Reindeer LLC. Now, the deal with Reindeer LLC is that he is not an active participant in this activity. That means that Reindeer LLC represents a passive activity for Rudolph, and he can only offset passive activity losses to the extent that he has passive activity income. Well, how much passive activity income did he have? He had $132 of passive activity income from his rental property. The amount of loss he will be allowed to claim on Reindeer LLC is only $132 out of $10,000. So we enter $132 of passive loss that is allowed in column F of line 28. And we need to prepare Form 8582 to show these calculations. On Form 85 and 82, we enter activities with net income for the year. That was the rental property, showing an income of $132. Then on line 3B, we enter all other passive activity losses for the year, and those total $10,000. We show that the difference between $132 and $10,000 is $98.68. $98.68 represents the amount of passive activity loss limit that must be carried forward to 2011 for Rudolph. Next, we're going to take a look at Rudolph's K1 from the corporation, Toy Makers Inc., and that K1 showed that he had a loss of $5,000 for the year. But remember that Rudolph only had $2,000 of cost basis in that activity, and since he is not fully at risk for his interest in the activity, we have to limit the loss on the activity to the amount he is at risk for, and we show those amounts using Form 6198. On line 1 of Form 6198, we enter the loss from the activity. He has no other carry forwards, so we carry $5,000 to line 5. Then on line 7, we enter the increases he had for the year. And during the year, he contributed $2,000 to the activity. So that $2,000 that he contributed to the activity is the amount that he had at risk for the year. He subtracts $2,000 from the $5,000 loss, and he will therefore have a $3,000 loss he is not allowed to claim and must carry forward. So what is the amount of loss he is allowed to claim? Well, the amount of loss he is allowed to claim is $2,000, and we're going to carry that up and enter it on Schedule E, page 2. And here is Schedule E, page 2, and the $2,000 loss that Rudolph is allowed to claim for the year. And you can see on line 28A, we entered Reindeer LLC, we entered partnership, and we entered $132 in the passive loss allowed column. For Toy Makers Inc., we have an S corporation. He has some amounts that are not at risk, so he checks box E. And then in column H, he enters the amount of loss he is at risk for, which is $2,000. We therefore show on line 31 total allowed losses of $2,132. $2,131 is going to be partially offset by the $132 profit he is showing on page 1 of Schedule E. That leaves him with a total allowable loss for the year of $2,000, and that $2,000 is the number that carries to 1040 line 17. And here we have $2,000 that we've now entered on line 17. Line 22 is the amount of income that Rudolph has for the year. He's allowed to subtract his allowable losses from $50,000 of income, and that leaves him with total income of $48,000. He has no adjustments, It leaves him with adjusted gross income for the year of $48,000. He claims a standard deduction of $5,700, a personal exemption of $3,650. He has taxable income of $38,650, and the tax tables give him tax of $5,850. He had $5,000 withheld on his W-2. He has a $400 making work pay credit. That leaves him with total payments and credits of $5,400. Not enough. He owes $450 with this tax return. Rudolph is also required to prepare and attach Form 4562 to his tax return. We did a lot of the work for you by showing you the depreciation schedule. So we begin with the dishwasher, which is 5-year property and is entered on line 19B. The cost of the dishwasher was $450. Recovery period of 5 years under the half-year convention. The method is 200% declining balance, and he gets a depreciation deduction of $90. The residential rental property was placed in service in the month of February under the mid-month convention. That will give Rudolph 10.5 months of depreciation. His cost basis in the rental property is $81,900. Under the mid-month convention with 27.5 years straight line, he ends up with $2,606 of depreciation. The mid-month convention also applies to the air conditioning and furnace, but those were placed in service in June, and ultimately under the mid-month convention he will be treated as being allowed 6.5 months of depreciation, and he gets an $89 deduction. So those total amounts come up to $2,785. So that concludes the review of the classwork assignment for Rudolph Deer. Please do take some time to carefully review the classwork answer key for Rudolph Deer. I think that if you spend some time analyzing the answer key and how we made all of the entries that we did, it'll start to tie together for you. And once you feel like you get Rudolph Deer, then it's time to move on and do your homework assignment for Mickey and Minnie Mouse. And of course, Mickey and Minnie Mouse have all of the same tax forms, for most of the same tax forms involved with their tax return. We have a 1040, a Schedule E page 2, a 4562, and an 8582. Mickey and Minnie need some extra cash, so they decided to rent out one of the bedrooms in their home to a tenant named Goofy. And on March 1, 2010, they converted one bedroom to business use. Their tenant, Goofy, has exclusive use of that bedroom and one bathroom. Goofy shares the kitchen and living room with the Mouses, and Mickey has calculated his home is 30% tenant use, 70% personal use. The Mouses have the following income and expenses. Go ahead and prepare their Schedule E using the following expenses. And because this is a co-use, part personal, part business, you're going to have to figure out the percentage personal use of the home and the percentage of each of these deduction items that is going to be allowed for Schedule E and the percentage that will be allowed on Schedule A. And in certain cases, no deduction will be allowed at all. Here is Mickey's W-2. Minnie is a passive at-risk partner in Pluto Inc. Her Schedule K is attached. Mickey works for the City of Magic. His W-2 is attached. The Mouses will receive an $800 making work pay credit. They also made some donations to charity, and here is Mickey's W-2. Here is Minnie's K-1 from Pluto Inc. Have fun preparing your homework assignment for Mickey and Minnie Mouse, and I will see you back again at the beginning of Session 18. Session 18 will begin with a review of the Session 16 quiz, a review of Mickey and Minnie's tax return homework assignment, and then in Session 18 we will, of course, discuss self-employment income and expenses and preparation of Schedule C and the Office Use of Home Form 8829. Thank you, and bye-bye.